All right, let's jump right into this explainer because we have got a fascinating financial paradox to unpack today regarding Tractor Supply Company. Now, if you follow retail stocks or the ag sector at all, you already know Tractor Supply is an absolute behemoth. But their first quarter 2026 results, well, they've created a really interesting puzzle. We've got a company hitting record sales, expanding its footprint like crazy, and yet they're facing some very real margin pressures that have analysts completely scratching their heads. So today we're going to break down the numbers, look at their long-term strategy, and figure out exactly what is going on under the hood of this rural retail giant. And we aren't just reading the news here. We're putting Tractor Supply through the ultimate stress test. We're going to apply the investment frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham to see if this stock is ultimately a buy, hold, or sell.
So here's the million-dollar question currently haunting Wall Street. Is this rural retail giant finally hitting a wall, or are they just shifting gears? Following that Q1 2026 earnings release, the chatter has been nonstop. Are the days of massive, outsized growth for Tractor Supply officially over? Look, the market had gotten pretty used to seeing this company command a massive premium growth multiple. Just a year prior, they were trading at a forward price-to-earnings ratio of 25. Now, that multiple has shrunk. To put it in Peter Lynch's terms, the market is really struggling to categorize them right now. Are they still a fast grower, or have they matured into a reliable but slower stalwart? Lynch would tell us that when a PE multiple shrinks like that, you have to look closely at the PEG ratio to see if the new price actually reflects their realistic growth rate. So to really answer this, we need to look past the immediate panic and dig into the structural foundations of the business.
To really get the numbers, we first have to understand who is actually walking through their doors. That bedrock demographic of recreational farmers and ranchers living the life out here lifestyle. This isn't your average big box store customer looking for a TV. Tractor Supply caters to a very specific needs-based market. We're talking about people who literally need animal feed, hardware, ag supplies, and outdoor gear, regardless of what the broader economy is doing. It is a highly resilient, consumable product base. And if we look through the Warren Buffett lens, he is always searching for a durable economic moat and highly consistent earnings. By catering to this specific, resilient market, Tractor Supply has dug a massive moat that protects its intrinsic value. This demographic is exactly why their Neighbors Club loyalty program is so wildly successful. It actually represents more than 80% of their total sales.
And just look at this macro growth trend. They expanded from $12.7 billion in 2021 to a record $15.5 billion by the end of 2025. What's truly incredible here is that 2025 marked their 31st consecutive year of revenue growth. 31 years. That easily checks the box on Benjamin Graham's defensive investor checklist for both earning stability and a strong financial condition. The engine is absolutely roaring. They've proven their ability to consistently capture market share in a highly fragmented $225 billion total addressable market. Fact is, they are operating from a structurally higher level of performance than at any point in their 85-plus year history. So top line, relentless momentum.
But here's where the financial paradox actually emerges in Q1 2026. Net sales rose 3.6% year over year to $3.59 billion. Awesome, right? Yet net income dropped 8.3% to $164.5 million. Operating income also fell by 6.3%. This is the exact disconnect that's making the market so jittery. The company is bringing in more money at the top line than ever before, helped out by double-digit digital sales and bigger average ticket sizes, but a lot less of that money is making its way to the bottom line as actual profit.
So, what's the culprit? It comes down to SG&A deleverage. Basically, their profit margins tightened up because the aggressive pace of building new physical stores, along with rising fixed costs, completely outstripped their same-store sales growth. In Q1, their comparable store sales or comps grew by a tiny 0.5%. When you're opening dozens of huge new retail stores, you are taking on massive upfront costs for labor, inventory, and real estate. If your existing stores aren't growing their sales fast enough to offset those brand new expenses, your selling, general, and administrative costs just eat right into your profits. That's the exact mathematical squeeze they felt this quarter.
Management, however, isn't just sitting still and taking it. Their Life Out Here 2030 strategy is essentially a massive capital expenditure plan designed to boost long-term free cash flow. They are betting that taking some near-term margin pain right now will build a modernized retail ecosystem that significantly bumps up their terminal growth rate in our DCF valuation models. The strategy doubles down on store localization, direct sales, a new retail media network, and a huge push into pet and animal RX. They're also sinking money into their supply chain, including breaking ground on an 11th distribution center in Idaho for final mile delivery. They are deliberately absorbing this SG&A hit today to secure absolute dominance over the next decade.
A huge chunk of this strategy boils down to physical dominance. They plan to aggressively open 100 bold new store locations in 2026 alone. 100! What's fascinating about this confidence is that while so many other retailers are shrinking their physical footprints or pivoting entirely to e-commerce, Tractor Supply is doubling down on brick and mortar. This selling square footage increase of roughly 4% is a very deliberate tactic to capture new markets and assert their presence in rural communities where physical convenience is still the ultimate king. And they are already sprinting toward that goal. They opened 40 new Tractor Supply stores just in the first quarter of 2026 alone. Plus, they're playing opportunistically, snatching up 18 former Big Lots locations to speed up the expansion even more. This isn't just about throwing stores everywhere. It's about doing it fast and efficiently. The data actually shows their new store performance is outpacing expectations in both timing and volume. That is a really strong signal that their site selection methodology is hitting the nail on the head. All this aggressive building adds to a network that ended 2025 with over 2,600 retail stores and 52,000 team members across the country. Talk about immense scale. And it's not just the core brand. This includes over 200 PetSense locations, too. They're also rolling out Project Fusion remodels and garden center transformations, which are already live in nearly 60% of their stores. This kind of scale creates a formidable economic moat. Again, it's exactly the kind of competitive advantage Warren Buffett looks for, making it incredibly difficult for smaller regional players to ever challenge their supply chain efficiency.
So analysts are doing some serious math right now, trying to figure out the stock's true margin of safety. They're weighing a short-term 100 basis point drag from soft companion animal and pet food sales against a 4% revenue uplift provided by these brand new store locations. Think about it. If the pet food business drags down overall comps by 1%, but new stores add 4% to the top line, the company is still growing. The real question is whether that growth is high quality enough to satisfy the market, especially with current inflation and tariff-related pressures squeezing gross margins.
To fix that specific pet food drag, Tractor Supply is getting aggressive. They are leveraging strategic acquisitions like All of It, which is a digital pet pharmacy that did over $100 million in sales in 2025. They're integrating VIP Pet Care to offer on-site vet services, and they're rolling out fresh and frozen pet food from 80 stores to 700 stores by the end of the year. They clearly see the softness in the companion animal category, and they're actively pivoting to higher-margin, premium items to win back that lost momentum. Looking ahead, management remains incredibly confident. Even with that Q1 margin squeeze, they firmly reaffirmed their 2026 guidance. They're still expecting 4 to 6% overall sales growth, 1 to 3% comparable store sales growth, and a diluted EPS between $2.13 and $2.23. On top of that, they maintain a very shareholder-friendly capital allocation, including a 17-year streak of dividend increases. That streak screams honest management to Buffett, and it hits Benjamin Graham's strict dividend record requirements perfectly. The CEO is making it clear they fully believe in their ability to keep taking market share while returning cash to owners. Wall Street, though, they're playing hard to get. Analysts are projecting comps closer to 0.5% for the year, rather than the company's 2% midpoint. If you're building a DCF model at home, this is where your sensitivity table is going to do the heavy lifting. That difference between a 0.5% comp and a 2% comp drastically alters your terminal value and fair value per share. Analysts are clearly wary of the margin pressures and potential softness in consumer spending. They see that 0.5% comp from Q1 and are basically projecting it forward, seriously doubting the back half reacceleration that management is promising, which leaves us with one final valuation puzzle. Is the market so hyper-focused on short-term drags that it's offering us a classic Benjamin Graham-style margin of safety right now? If those 100 new stores hit their stride and the digital sales keep booming, this current valuation might just be a tiny blip on a very long, very successful trajectory for the ultimate rural lifestyle brand. So, based on the economic moats, the cash flow projections, and the growth frameworks, what is your final synthesis? Is Tractor Supply a buy, hold, or sell at today's price? Let us know what you think.